Welcome to the topic of competition. Now we are moving into trying to understand how to protect sources of value creation in companies. And to do this, we go through a little bit of an overview of a traditional topic, which is competition, and how we basically try to understand the differences across companies in the initially in industry, at the industry level, competitive structures, and the strategies that companies can undertake within the industry, and then the story of competitive dynamics and interactions, and then finally the idea of competition, which is part of these competitive dynamics. So with this, let's start with very additional ways of understanding competition. How do we protect sources of advantage? Well, we have to basically deal with others, compete with others. This is going to, over time, undermine our ability to create value for customers. And the logic here is trying to go deep into the different concepts. So a little bit an overview, competitive statistics. This is the structure of the industry as such. We'll see later how things change over time. We have the perfect competition. What is perfect competition? It is a laboratory, and this is a concept that we use often. And the reality is that there are few or pretty much no industries in which we have the conditions of perfect competition. We have to have lots of buyers and sellers. The product is homogeneous, it's a commodity, you cannot differentiate, it is pretty much the same for everybody. Everybody has perfect information. This is not something that happens. And then there are no transaction costs. You can buy and sell without having to incur in not only the cost of basically buying and selling, but also in finding sellers, finding buyers, and basically promoting your ideas. And then if companies want to enter the industry, no barriers to entry, and as well, there are no sunk costs. They can basically exit very quickly, and all the companies have the same technology. Under these conditions, which are ideal conditions, this is a laboratory. What we have is pretty much companies covering costs. There is no extra extra profit or rent that they can get, because if they basically try to raise prices, they are always going to be undermined by others that are selling the same product at a lower price. If they happen to drop prices, they might not be able to cover costs. Some companies might have to exit. The reality is that if under these conditions, pretty much you cover costs and that's it. Not a good position for companies. What are the better positions? The best one, of course, is monopoly or monopsony in the case there is only one company buying. Monopoly is in case of one company selling. One company basically establishes the prices and the quantities that are going to be produced and sold to customers, and there might be issues of some cases, many cases, high barriers to entry, as well as high barriers to that prevents other companies from coming in, and the ability of the company, the monopolies, to basically exclude others. Why is this possible? In some cases, this is, if you want, a story of natural monopolies. Well, if there is a big investment to be made, it might be basically better to just have one company. There are lots of economies of scale, very large production, very big fixed costs, and as a result, you incur those costs, you can drive your prices down. It's very difficult for somebody else to enter. These natural, if you want, conditions, in many cases, technology has undermined them. Once upon a time, there was an idea that, well, telecommunications, it's easier if there is only one single company cabling all the different houses, otherwise it's going to be duplicate investments. Nevertheless, now we basically move, if you want, into over-the-air communication. All of a sudden, the idea that there is only one company, this natural monopoly, has been undermined because now we have competition thanks to over-the-air communication. Network effects are also important. The idea here is that more buyers we have, sorry, the more users we have of one product, the better it is for everybody. It is more attractive. Everybody basically comes to that particular company. Typically, if you want an example, social networks in which, of course, if everybody is in this network, I'm going to join that network because otherwise I'm not going to be able to communicate with others. Once everybody's in the network, it's very difficult for others to come in. Nevertheless, as we have seen, social networks do evolve, and in some cases there is some substitution of one for another. There is, of course, a legal establishment of monopolies in which the government decides that it is better for society. It can be at the country level, it can also be at the subnational level, that it is going to be only one company, the one that is going to be providing a particular product or service. For example, public transportation tends to be state-owned and it tends to be a public monopoly. It doesn't have to be state-owned, but in many cases it is. It is better to just have one company that is going to be providing subsidized transportation for people in an area. So the idea here is you are going to exclude others. A similar story happens with technology. Patents are a legal monopoly over the use of a particular set of knowledge over a period of time. So the notion here is there is going to be an ability for a company to exclude others and basically as a result be the only company operating, and in many cases they is associated with high profits. What happens with this? Well, there is a story that because it might not be good for consumers, then therefore we should basically be dealing with it with antitrust or anti-competitive practices that may happen here and try to basically prevent this. The other, if you want, a market structure, which is the most typical, oligopolies, in which we have multiple companies, a few companies that to some extent have some degree of influence over the decision of buyers to purchase their products. Few sellers, there's maybe some barriers to entry. It might be challenging in expensive investments. There might be the discussions we had before, some network effects. And the notion here is that unlike what happens in perfect competition in which my actions are not affecting others, the market sets the price. Monopoly, one company sets everything. If I start changing prices, it's going to have an impact on other companies, and therefore there is going to be a reaction. And here what we may end up is with cooperation among a few companies to try to accommodate each other, not to get into too much competition, or in some cases a lot of competition in which companies try to basically undermine others and eventually force them out of the market. Example, a duopoly, if you want, the case of ride-hailing in the US, in which you have both Uber and Lyft, the two companies that are now losing money and have been losing money for a long time, partly because there is this idea that eventually, if they're able to kick the other company out of the market, it will become monopolies and to some extent benefit from network economies and eventually achieve that profitability. And then finally, and this is also another, if you want, market structure, is monopolistic competition. It's not a monopoly in the sense that there is not one single company, but for some buyers, this particular company and the offering that the company provides, to some extent, some monopoly in the sense that I like that type of product. It might be the brand, it might be the technology. I am basically connected with that, and it's going to be difficult for me to be enticed to move to somebody else's products. There's lots of companies, products are differentiated, and it's either, well, this is the brand, this is the particular logo that I like to wear, or this is the particular technological platform, and this is what I use, and it will be difficult for me to move. Apple, for example, has established this particular ecosystem in which once you are within the ecosystem, it's so easy to use everything. It is nicely integrated. Yes, prices for alternative offers might be there, but I'm not going to be enticed just because of the price, because then I will basically have to switch all my technological products to the other platform. So this is the notion that there are different types of competitive market structures, and this basically drives our understanding of how, if I'm running a company, I might be undermined by competition in my ability to continue my value creation and capture over time. So with this, these are statics. some strategies that companies can implement within these different options. Traditional strategies, cost leadership, differentiation, and then focus on one of them. The notion here is, am I going to operate in most of the different segments, or am I just going to select a particular niche? And is the basis of my competitive advantage cost, which is I'm just focusing on trying to be really efficient and try to force my cost down, so that if the price is above it, I'm going to keep that margin. And if I am the lowest cost producer, my margin is going to be bigger than other companies. Or am I going to go for being different, better than others, differentiation, so that yes, it's going to be more costly because I might have to invest more in innovation. My products might have to go more through design or marketing. But at the same time, I'm going to be able to be asking a premium from consumers, and consumers or customers are willing to pay for that. So I am still going to be able to keep that premium over my costs. So the idea here is two different broad competitive strategies within that different niches. Within that, how do we achieve this? So this is not something that is coming out of, if you want, the air, but this is part of the strategy. For cost leadership, a focus on economies of scale. Economies of scale, which are related to that, and learning economies. What are economies of scale? The idea that within a period of time, I'm going to take all my fixed costs, and if I produce more units, I can basically allocate these fixed costs over a higher number of products, and as a result, my per unit cost is going to be lower. So there is an incentive to basically produce much more within the period. Economies of scope related to this, but it's not just one single type of product, but different types of products that might have some level of interconnection in terms of the technology, in terms of the market, in terms of some of the components, so that I can still play with this idea that I have really large fixed costs. How can I basically reduce the per unit cost by allocating them among a higher number of units? Learning economies is a slightly different story. It's not a per period reduction in cost, but over time. The first unit I create is going to be much more complex. I don't really know how to do it well. I'm not really well, have not designed well the process. Over time, I learn how to do it better, how to do it faster, how to do it with fewer mistakes. And as I continue doing it, after several interactions, several thousands or millions of units, my costs are going to be coming much lower. The notion here is that I'm getting out of the imperfections that I have at the beginning. A similar story happens if you want a personal reflection. The first time that we have to write an academic report is kind of complex, messy, you go into different ways, it takes much long. After you have written the second report, well, it's so much easier because you have learned how to do things better, you know where the information is. By the time you have written the 20th report, everything is so much faster, everything is just easier because you have been learning over time. It's just the number of cumulative projects or cumulative products you have to be producing, not just per period, but over the lifetime. And then the other story, how do you reduce this? Operational excellence. The idea here is focus on efficiency in the processes, trying to reduce inputs that come in, trying to reduce the time that you're going to be using it, trying to basically achieve that level of efficiency so that it's always a focus on cost. How do you use it? Price competition. It's kind of the simplest way. It's not the best one because that basically means that you are trying to sell on the basis of pure price. You are commoditizing your product. At the end of the day, there is a story that, well, just a little bit lower, a little bit lower, a little bit lower. Prices are not great, but this is pretty much one way to basically get, especially in products that are difficult to differentiate. Maybe try to pull some ideas that, well, if we unbundle things and we get into the good, better, best products, maybe I can get some differentiation, although I'm still focusing on the low cost. Example is airline seats. So once upon a time, if you want, airline seats were one price, and it came with a lot of services. You could choose your seat, there was a meal, you could basically bring by suitcases with you, you have to pay for them. Then low-cost carriers came in, and the idea wasn't bundling. So it's not just the whole service, but it is going to be, if you want to go from one place to another, this is the price. If you want to bring additional suitcases, you pay extra. If you want to choose your seat, you are going to pay extra. If you want a meal, you are going to pay extra, so that the initial price was basically split into the different services, and then now we focus on just the pure transportation. Of course, individuals, we don't really like the bare minimum unless it's just for a very short flight. If it is a longer flight, maybe it's something better. So we get into the pricing of the good, better, best, in which, yes, I attract people with the lowest price, but at the end of the day, I try to sell additional services, additional features, so that I basically have a higher margin. So this is, if you want, another way of trying to go for the lowest cost of production, but trying to go beyond pure price competition. The other story, which is differentiation. How do I achieve this? Well, we are going to have the best product. It's going to be the most innovative. It's going to be the highest quality, better materials, better craftsmanship. And the idea here is that because this is obviously, and it's not just perception, but to some extent you can see that this is a better product, you are going to be willing to pay more for this. The idea here is focusing on premium pricing and consumers or customers willing to pay for that. It is a better product, it's going to be more reliable, the car is going to be superior, or it's going to be customer intimacy, a better total solution. I'm not looking just for a better product, that computer that has the fastest processor, but I'm looking for a computer in which I don't really need to know anything. It's going to be the simplest way. I open, it is ready, I can start doing things. I don't have to basically get into a learning experience. It's going to be understanding what I'm looking for, and then basically trying to reduce, if you want, the additional cost I'm willing to pay for a company, basically taking care of a total solution. How do we use this? Innovation races. Let's add something better, newer. Smartphones were one example. Initially, it was basically new features, different features, very different designs. Eventually, we converged into the traditional design of a touch screen. And now, different generations, it was a faster processor, it was a better camera, it was a longer lasting battery, then it was not on one camera, maybe two, now it's the next generation is 3 cameras, maybe this has a stylus, and this is going to be a slightly bigger screen. So you are getting one after the other, trying to outcompete the others. Because systems and platforms are another way in which you are basically trying to connect with others. The platform is story in which lots of buyers and lots of users are connected by one company in the middle. The notion here is playing with a network economy, so that it's difficult for you to basically move to an alternative platform. And then also, you have a lot of customer knowledge. You do understand well what they are looking for, what they want. You are able to offer them better services, better products, more products. You're trying to basically sell them some more things. And then the idea of creating switching costs, and the notion that, well, if your life is within this particular platform, it's difficult for you to basically move to an alternative one. Or not just because it's one product, but all your products, all your technology is within Apple. Moving to PCs and Android is basically throwing away to some extent the technologies and also the knowledge that you have. So the idea here is it's difficult for me to go to an alternative. I'm going to stay here. I'm willing to pay that premium. So these are the two main strategies, competitive strategies. All of these are to some extent very static. We can get into more dynamic ones, and this is the competitive dynamics interactions. The notion here is that it's not just this is what it is, this is the structure of the industry, and this is my competitive strategy, but how am I going to change my competitive strategy, and how eventually some of the industry characteristics may also change. So here is relatively, if you want, simple introduction to game theory. Cooperative, non-cooperative, the notion here is, am I going to talk to my competitors and try to basically get an agreement so that everybody benefits, or am I just competing against them and there is no level of cooperation? I'm not sharing information, I'm doing my things, and then my actions might have an effect on them. And then I have to react to how their actions are happening. Zero sum versus non-zero sum. If we get into this interaction, is it just whatever you gain, I'm going to lose, or can we basically gain together? That is, if you want a bigger pie to be split. And then the notion of simultaneous versus sequential. Are we going to be doing things at the same time, or do I take an action, then there is a reaction, then it is my reaction to reaction, and things like this. Tit for tat is one of, if you want, the traditional arguments. The prisoner dilemmas is the other one. Do I accommodate? Do I respond? Do I not respond? Do I basically go very harsh against them, or just basically try to go into soft, so that because I don't want into competition? And the notion here of first and second mover advantages. Am I going to be the first in the industry to introduce new products? It might not be the best product, but it's going to be basically bringing the notion that I am the innovator and I'm going to get all these people willing to try new products. Or am I just going to wait for somebody to be the innovator and then basically I'm a fast second in which, okay, that's really nice, but it's not really perfect. Can I basically improve it, and can I introduce a much better product faster than they can improve their own product? And then the notion of competition we are going to see in a minute. The prisoner's dilemma, a traditional one in which we have two different, and this is a non-cooperative game, two different suspects. They are accused, or they're considered to be participating in a crime. They are put in separate cells. If one person confesses, I'm cooperating with justice, they are going to get a reduced penalty. If the other one is not cooperating, basically gets a harsh one. If both of them don't cooperate, you don't know who is guilty, so therefore the penalty is going to be lower. Challenge with this particular game is that, well, there is an incentive to basically cooperate, talk to the police, confess, and then to some extent you end up in a situation in which you are going to be getting more than if both of them could coordinate, and this is the important thing. This non-cooperative and they cannot coordinate. They can coordinate, both of them are going to get much lower penalty. The tit for tat, and it's a very nice example, is what happened a couple of years ago when there was a trade war between the US and China, and the US started with some tariffs on $34 billion of products, and China basically, Chinese government basically did the same thing. So it is 34 billion, then the US government decided to add more tariffs, another 16 billion. China, the Chinese government decided to do the same thing. Then it was 200 billion because to some extent that was the difference in the trade flows. China went with 60 billion, which was the remaining at 10%, then it was 25%, then it was 25%. This is a tit for tat story in which there is a story. This is one of the problems. There might be a story of escalation. If I do something and you react, it's a signal that, well, I'm going to be trying to basically imitate what you do. There might be a story of also de-escalation if I unilaterally basically reduce it. The logic here will be, well, why don't you just imitate? That way we basically go into de-escalation. The notion here, or the big idea behind competitive dynamics, is going beyond the traditional industry structure and competitive strategies, and trying to understand how there is a game in which there is always a continuous interaction, there is over time, what am I going to do today, how are they going to react, how can I react to them, so that I'm thinking much more long-term rather than today, this is what it is, take it for granted, and this is what the actions that you take. And finally, the notion of competition, a particular way of understanding things, which is we collaborate. We're competitors, and instead of just competing, there might be some occasions in which it will be good for us to collaborate. We can generate additional value by being together. Challenging idea because there is always the notion that, well, antitrust is there to avoid this type of cooperation because in some cases it might not be good for consumers, but nevertheless there are incentives to basically get into competition, not just to reduce the level of competition that happens in an industry, but there might be other benefits, which are, for example, 4 different ones. We can learn together. We are not the best ones. We can help each other. We can develop something that is new, that is better, that is different. This is going to be helpful for us. It's going to be, to some extent, helpful for our customers. Maybe I can try to block current competitors. So it's kind of the enemy of my enemy is my friend. So I'm going to work with somebody else so that we can basically make life harder for others, and both of us are going to be getting some benefits, or we can get into kind of a learning race in which, yes, that company might be superior, but nevertheless, it might be good for both of us to continue improving so that to some extent I keep check of what they are doing. And in any case, we are learning together. And then finally, yes, we are thinking about current competitors. We might try to block them, but what if we try to basically limit future competitors so that we basically collaborate to try to use the advantage of others. The notion here is thinking about not as competition with competitors in the industry, but in many cases there is the incentive to establish collaboration. And this, if you want to go deeper, is very typical, for example, in complex products, technology products, smartphones, for example, in which, yes, Apple and Samsung are competing on the sale of smartphones. At the same time, Samsung is a big supplier of parts that go into Apple products. So the notion here is that, yes, there is benefits for everybody from cooperating, but again, the notion that at the end of the day, there is a fine line between cooperating so that there is a general benefit that can have a spillover to others, and the notion that we are cooperating so that we can exclude competition, we can reduce competition, we can benefit, and then antitrust might basically come into play. And of course, how do you structure this? Similar to discussions of alliances or acquisitions. What do we want to do? What is the objective? How are we going to structure, negotiate what we're trying to achieve, and to some extent thinking about the long term, under which conditions are we going to get out of this. So eventually, are we creating value? Is it going to be equal value for both, or do we decide, well, I'm really getting much more value to maintain the cooperation? Maybe I need to compensate and get you additional value. So with this, this is to some extent the notion of protecting sources of competitive advantage. Yes, what is competitive advantage? I am better than my competitors at satisfying customers. Of course, my competitors are going to continue trying improving so that they can be better than me at satisfying customers. How do we understand this? We have to go deep into basic notions of competition that are below this idea of protecting sources of advantage. Understand the market structure. Are we in something that looks similar to perfect competition? How do we operate there? It's mostly going to be taking prices and pretty much focusing on commodities and low prices. Are we a monopoly? In that sense, how am I going to dominate and exclude others from coming in? Is this an oligopoly? Do I establish some basis to basically reduce the level of competition, try to collaborate with others, and try to maintain this implicit collaboration, again, with the notion that I might get into trouble with antitrust regulation. And then the story of monopolistic competition. How do I, even if there are lots of competitors, I bring customers, consumers to my products because they think that this is basically what fits what they are looking for. It gives them solutions that they cannot find elsewhere, and they are going to continue with this. Competitive strategies, cost leadership, and differentiation. You are going to be the best at something, you are going to go and reduce cost, and you're going to try to basically keep a premium, or sorry, a margin because the price is above your cost, or you are going for differentiation. You are going to understand and produce better products. You understand what customers need, and you provide solutions, and they are going to pay a premium. And even though your costs are higher, you are going to basically get a margin. Competitive dynamics and directions over time, thinking about the long term, not just today, but what is going to be their reaction that other companies can have. And depending, this depends a lot on the type of industry structure and the story of competition. We can collaborate for mutual gain, and there are 4 different options, mostly a story of learning or competition, limiting current and future competitors, learning together or learning race. The notion here is going beyond the idea that competitors are companies, against and just going to be focusing as quote unquote enemies, and in many cases, well, competitors collaborate together. There is mutual benefit to basically working with them. So that's all. Thank you very much. And I hope that you found this interesting. Bye-bye.